US Treasury yields continue to rise and global stocks are falling as hopes of multiple Fed rate cuts are fading. A strong US dollar sees the yuan slide towards 16-year lows, triggering intervention, and the oil price rises again overnight after new US sanctions on Russian exports. That's coming up in our 5 Things in 5 minutes. And then in today's bonus deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner previews how New Zealand's economy looks set to perform over 2025.
It is just worth bearing that in mind, that the Reserve Bank will be weighing up the risks on both the upside and the downside to inflation.
But first, in 5 and 5 with ANZ, weakness in the US stock market overnight has added to early 2025 jitters, triggered by rising bond yields and fast disappearing expectations the Fed will cut rates again. At 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.5%, while the yield on 10-year US Treasuries was up a further 2 basis points to 4.79%. Rising oil prices also added to the inflation picture, with new sanctions hitting prices. West Texas Intermediate rose more than 2% overnight to $77.50 a barrel. ANZ head of G3 Economics, Brian Martin, says it's been a hectic start to the year ahead of key US inflation data later this week.
We saw inflation expectations rise in the early January Michigan Consumer Confidence Report. There was a brisk labour market report for December showing jobs rose 256,000. The unemployment rate dipped 0.1% to 4.1%. So the labour market's staying really quite firm. The market is really uncertain about what the incoming Trump administration's policies on tariffs and immigration will have on the inflation outlook. And you've had a Fed that has moved to be more cautious.
As of 4 a.m. Sydney Melbourne time, the US dollar index was up a further 0.2%. The Aussie dollar was trading up 0.16% at 61.59 US cents after that big fall in the last couple of weeks, while the Kiwi was down 0.05% at 55.57 US cents. Number 2, China's yuan has begun the year sliding to new 16-year lows, forcing all sorts of intervention by the authorities in Beijing. The prospects of big new tariffs from a re-elected Donald Trump is hitting sentiment. But as ANZ's head of Asia research, Koon Go, explains, there's also a widening differential between US interest rates, which are staying high for longer, and Chinese interest rates, which are now slumping to record lows on fears of deflation. That differential is now over 300 basis points between the US 10-year Treasury yield at 4.79% and China's 1.65%. Here's Koon on how Beijing is responding.
For now, the Chinese authorities continue to try and keep the yuan stable through steady fixings. They've also tried to support the yuan by increasing funding costs in Hong Kong through issuance of a record RMB-denominated bills that's designed to try and make it expensive for people to offshore yuan. They've also temporarily stopped buying CGBs from the market to stem the decline in yield. And today, they've just increased the macroprudential parameter, allowing companies to raise more offshore borrowing in the hope that that will convert into yuan to support it. So they've done all these to stabilize the yuan, but I believe these are only temporary measures.
Number 3, Koon says that ultimately the yuan will be forced lower, but not before the Chinese New Year.
The last thing they want is a sharp depreciation in the currency heading into such an important auspicious holiday period.
So just give us a sense of how much the currency has moved in historic terms.
Well, the yuan is currently holding at around the 7.33 level in onshore spot, around 7.35 in the offshore. Just to give you a magnitude of the amount of pressure that's under, the last time that the US-China 10-year yield differential was over 300 basis points, the yuan was trading over 8. Now, that's not to say the yuan could potentially weaken to that level, but again, it just shows you the amount of pressure it is under just simply from the yield differential basis.
Number 4. Meanwhile, Australia's jobs market is proving more resilient than expected. The ANZ Indeed job ad series rose in December from November, meaning the December quarter was up for the first time in 2 years. Here's ANZ Australia economist Maddie Dunk on why that resilience is important for the Reserve Bank of Australia as it looks at whether to cut rates next month.
The current resilience in the labour market, which is being reflected in this stabilisation in ANZ Indeed job ads, is one of the reasons that we expect quite a shallow easing cycle from the Reserve Bank. So we only have 2 rate cuts penciled in, 50 basis points of cuts, which would take the cash rate to 3.85%. And one of the reasons that we do think that the easing cycle is going to be quite shallow is because of what we are seeing in the labour market at the moment, the fact that people are keeping their jobs, the fact unemployment rate remains low, and the fact that job ads is holding up, and indeed it actually increased in Q4 last year.
Number 5. There's another story of surprising resilience coming out of China, where exports are booming despite all the talk of tariffs and economic slowdowns, and even imports are also up again despite weak consumer spending. China reported exports grew 10.7% in December from a year ago. That was much faster than the 7% consensus. Imports actually grew 1%, when economists had expected a fall of 1.5%. ANZ senior China strategist Zhao Pengxing says there's plenty of front-loading in these figures, as exporters and importers of intermediate goods for assembly in Chinese factories scramble to get those bits and pieces into and out of the United States before tariffs kick in.
I think both front-loading demand will continue in the next few months because we don't see immediate tariff on China from the Trump administration. So in Q1, we might see another peak of China export.
Zhao Pengxing there in China. Now, in today's deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner previews the year ahead for the New Zealand economy after a very rough 2024.
Exactly what that looked like has been subject to a bit of flux. There was a lot of revision to the GDP data last thing before Christmas. It changed the profile and suggested the weakness was more recent. But one way or another, it's pretty clear that 2024 was a very difficult year for large swathes of the economy. And of course, that was deliberate. That was deliberately engineered by the Reserve Bank via higher interest rates in order to get inflation pressure down. So the big question now is, are we there yet? The Reserve Bank has decided they have done enough, and they started cutting rates in August, and indeed they picked up the pace of cutting and have been delivering pretty rapidly, actually. We've had a couple of 50-point cuts. They've suggested another one is going to come in February, and the more recent weakness in GDP suggests that is certainly looking likelier than not.
But will inflation fire up again?
Now, that seems an odd question to even ask when we've just seen the weakest 6 months in New Zealand GDP since the early 1990s. But there were just a few suggestions in our Business Outlook survey that costs are sticking around and in some aspects may be worsening. So it is just worth bearing that in mind, that the Reserve Bank will be weighing up the risks on both the upside and the downside to inflation. There are certainly risks on both sides, and different commentators are focusing on different risks, but it's the Reserve Bank's job to try and steer a path through the middle.
So how rapid might the recovery be?
There's a range of views out there which makes perfect sense, but our own Business Outlook survey is suggesting that actually it could be reasonably vigorous. We've seen in particular a lift in past activity. That question has got the best correlation with GDP, which isn't surprising. Firms know best what's just happened rather than what's going to happen a year from now. So you can certainly discount things like record high business confidence. I mean, it dipped a little, but it's at very, very high levels. You can say, oh, that's just the starting point. The bar for improvement is low, and there's certainly something in that. But when you see firms actually saying that what they've experienced in the last month, more firms are now saying that things are on the up. And so that counts for something. And so it does look like the Q4 GDP, of course we won't get that till the end of March, but it does look like that's going to be the start of the recovery. And so we are anticipating a much better 2025. That said, different parts of the economy do respond at different speeds to lower interest rates. Some, like construction, for example, are getting an immediate lift, whereas retail, that really will depend on the interest rate people are actually paying. And because we have such preponderance of fixed mortgage rates in New Zealand, that relief's going to take a little bit longer to come through. But even there are some green shoots. So it's probably in a situation where things are going to continue to feel worse before they feel better. Because when people think about how bad a recession is, they think about things like unemployment and business failures. Those things lag activity by quite some way, so they're likely to continue to deteriorate. But under the hood, our estimation is that the economy has turned a corner, that interest rate cuts are working, and that better times do lie ahead.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, January the 14th. Watch out tomorrow for more on what's happening in India, where the rupee hit a record low and India's stocks fell 2.5% overnight. And there's debate about whether the Reserve Bank of India will and can cut interest rates next month. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.